Okay, we're going to do Unit 4, and we're going to do Source of Finance, or Finance, the name of the chapter. I'm just going to do the short-term sources of finance, just quickly do a recap on them. So there's any number of short-term sources of finance you can use. You need to know about 3 to 4 of these in the exam. So you have your bank overdraft, you have accrued expenses, credit card, trade credit, factoring. Now just be careful in the ABQ, if they decide to ask you about short-term sources of finance, you can only use the ones here that are relevant to the case study being asked. So you have to be careful of that. Now, your bank overdraft, what do you need to know with all of these? You need to know, be able to explain what they actually are and give advantages and disadvantages. So your bank overdraft, basically, it's when you have a current account, they allow you to take out more money than you have in your account. So the current account holders are allowed to use this, and you withdraw more money than is in your account. Very basic. Accrued expenses, this is where you just delay the payment of a bill. Say for example, your ESB bill, you're delaying paying your ESB bill. And again, that's okay as long as you don't let it go too far and then you end up getting cut off. Your credit card credit card are actually brilliant cards to use if you use them correctly, if you use them and pay them back within the month. So you buy now and you pay later, but it's very expensive if it's not paid. Trade credit is basically you get the goods now and then you pay later. So very, very similar, but trade credit means it's suppliers that you're dealing with all the time. You could actually use a credit card to pay them as well if you wanted. Factoring is, I've covered on your short questions recently. So factoring is you sell your debtors to a factoring company. So you really need, you say your cash flow is short, you really need your money, you can't wait to get the money off your debtors, so you ask the factoring company, will you get the money off the debtors and give me my money now? Obviously if you're doing that, they're going to take a percentage of what's owed to you, so you will lose out on that. Okay, so you need the 5, to know about the 5 of these, be able to talk about them. Now, when you're talking about the advantages and disadvantages of any of the 5 of these, or any of the sources of finance, I'll be in the next video, the medium term and the long term. I want you to compare them under these 5 headings. Okay. So you're going to compare them using cost, security, tax implications, control and repayments. Now, I will put the 5 of these up, even though 2 of them aren't actually relevant when it comes to our short-term source of finance. Security and control aren't really affected when you use the 5 of these. So I'm going to say security is not affected and control is not affected, and you can use that for all 5 of them. Then your cost, yes, there is a cost. Let's go through these. The cost for the bank overdraft will be your interest. The cost of delaying payment of bills, you might face a fine for paying them late, or you might lose out on a discount for not paying early, or you might end up being cut off your service. The credit card, it's very, very expensive if you don't pay back within the month. Trade credit, again, someone's giving you goods that you deal with, you buy a supplier that you buy off all the time. They've given you goods, and if you constantly don't pay them in time, they may stop giving you trade credit, and you'll always have to pay for cash for your purchases, which will put your working capital under pressure. So again with this, and if you're doing trade credit as well, you will probably lose out on discounts for not paying early. And factoring, I just said it to you a few minutes ago, factoring is, say debtors could owe you 100,000 and you sold them to a factoring company, so it might end up that you might only actually get 90,000, so it costs you 10% of what you were owed. Okay, the tax implications, just to explain tax implications, I'm just going to go back, just a little note here to explain, especially for those of you not doing accountancy, what a profit and loss account will look like. Now I have 2 scenarios here. I have a gross profit of 20 and 20. These expenses do not have interest in them, and these ones I put in that you have some sort of interest payments. So in this scenario, the interest, you don't have interest, so your net profit is 10,000, and say the tax rate is 10%, so you pay €1,000. Now what we say is, when you're calculating your expenses, you kind of want this figure in one way to be high because you like the profit, but you want it to kind of be low as well because the amount that you're going to be taxed on. So what we're saying is you're allowed to take away your interest payments from this figure before you calculate your tax. Whereas if you look at our dividends, you pay your tax and then the dividends come out. So we're going to be seeing later, dividends are not tax deductible, but interest is. It just means you can take off your interest. It can be included in your expenses before you have to calculate the amount of tax that you have to give to the government. So tax implications, yes, all interest is tax deductible. Okay, I would highlight that one there. So I said over here, control I've already said is not affected. Every one of these has to be repaid except this one. Okay, so this one you've got rid of your debts and you don't have to worry about it anymore, but obviously you've lost money from not receiving the full amount from the debtors.